Agenda of the paper is focusing on Chinese outwards mercantilism. And let me start by looking at the photo at the bottom right. This is Christina Kirchner. And this is a ceremony celebrating a significant agreement with China. And this agreement is dealing with several dimensions. One dimension is the provision of swap lines in Lumbini to the tune of $11 billion, and a significant portion of this already was used by China. And the continuation of this is that the two countries agreed that China will spend a lot on infrastructure investment, including hydroelectric power, shipbuilding, fast rail system, and atomic plants, whatever. And so we are talking about big, lumpy projects, and most of them are co-financed or financed by China. And in exchange, there is the other side commitment that Argentina will service this by exporting for the indefinite future. Now, this is really an example of a string of numerous agreements that have quite similar characteristics, mostly between China and developing and emerging markets in Latin America and in Asia and also in Africa. And the focus of this paper is to track the timeline of these disagreements and the logic behind the potential bundling. So the main points at the beginning are that before the crisis, China was a prime example of a country that was doing very well, focusing on export-led growth strategy, which involves a lot of dimensions that are summarized here. Let me skip these dimensions because of the shortness of time, but the point is that the crisis terminated a lot of this strategy. Because if you recall, before the crisis, China was growing up at a rate of 10 to 15 to 14%, and around the crisis, the current account surplus of China reached 10% of the GDP, implying that it was overly dependent on foreign demand for 10% of the supply of GDP, and of course, the crisis changed it altogether. So I'll argue that the export-led growth path of China has been challenged by its own success, and I'll try to explain what I mean by this. And the crisis triggered China a switch from export-led growth strategy to outward foreign direct investment, which entails also export of services, especially construction services or infrastructure, mining, and the like. And this is bundled with exporting Chinese finance, labor services, and capital goods. So in a way, China is willing to finance and build a lot in emerging markets and developing countries. And this, to a degree, allows China to maintain part of the drive of export-led growth, but changing the orientation in the way that is described here. So a famous example of this is really the fast rail system, and it's a huge potential market, and China is willing to push it to countries that before were massively underserved by other suppliers, i.e. mostly European suppliers. Now here in a nutshell, you see the map that is summarized the agenda, and the key point to recognize is that there is important presence of China in Africa and Latin America, and of course in Asia. So, and most of these changes are the outcome of the global financial crisis. We have not seen this drive really before the crisis. And it's not an accident, I'll argue. Now, in a way, China is filling a void because there are trillions of dollars needed to build the shortfall of global infrastructure in developing countries. Here we can see the summary of the data. But China is willing to engage and to finance and to build, subject to what I refer as the bundling strategy. Now, why is it important? Here you can find a summary of the Chinese net foreign asset position. And this is indicative of serious problems. China is low on yielding assets because 2/3 of the assets of China in the balance sheet position are mostly reserves, and China is short on high-yielding assets. Now, specifically, if you are looking at the liabilities of China, roughly 2/3 of the liabilities are the outcome of past inward FDI into China. Part of this is a joint venture of multinationals operating in China. And these are quite expensive liabilities because they are delivering much more than the reserves of China. Roughly 2/3 of the assets, foreign assets of China, and this goes back to 2014. Of course, now the number is slightly lower. 2/3 are in the form of very safe but highly or low-yielding reserves. And notice that there is a large deficit of approximately $2 trillion between the large exposure of China to inward FDI by multinationals to China and outward FDI that was roughly 10% of the balance sheet. If you're looking at the situation is that China is entertaining negative net return on its net foreign asset position. Now this is a dual chart. What you see here on the right is the net foreign asset position of China on the right scale. It was practically zero in 2000-2001, the year of the accession of China to the WTO. From then on, the runaway current account surpluses that reached 10% of the GDP at a time that the growth rate of China exceeded 10% led to a large increase in net foreign asset position that reached roughly 20% of the Chinese GDP around the crisis. But notice that this chart, which is reported investment income, is indicative really of negative income. If you're asking, well, what is the solution? One solution is gradual rotation from the low-yielding reserves to higher expected yielding foreign equity and outward FDI. And this is exactly what we detect looking at the data from the onset of the crisis with a lag of maybe a year or two. So the main idea is that if one is rotating the reserves down the road into increasing the outward FDI of China, and if this is done properly, then the hope is that the net effect will be increasing the very low return. Now the benchmark is very low because the return of China on its assets is negative. If you're looking at the real return for China, internalizing the fact that on average China has appreciated, so the return on reserves was very low. So even if China will goof in some of this outward FDI, chances are that it will be better. China will do better than the negative real returns on reserves. Now, why does it matter? Here you can see, in a nutshell, China has a problem. It used to be very low, a young society in 1970. Roughly 7% of the population was at the age of 65 and older. In 2050, the projection is that more than a third will be at this age group. Now, for this, it's useful to buffer the country with net foreign asset position, and 20% that are yielding negative return is not enough. This is in contrast to Japan. Japan is the global leader of aging. This is in going back to 1950, 5% of the Japanese population were older than 65, roughly 21% around 2008, if I recall, and then the projection is 40%. Now, unlike China, Japan is sitting with roughly 55% of its GDP as net foreign asset position, and they are definitely yielding much higher return because Japan is quite in a good position of accumulated large outward FDI of Japan. So what you see here is a nutshell. This chart is focusing on Chinese FDI stock abroad. It was practically low, very low, until the crisis. There seemed to be a takeoff after the crisis, and interestingly enough, a lot of the activities are focusing the outward FDI into Africa and Latin America. Here you can see the global distribution, and notice that most of the activities is in Asia, then in Latin America, in Africa, with a minor presence in Europe and in North America. And here we are focusing on the distribution of Chinese outward foreign direct investment flows and stocks. here there is a quick overview of the events before the crisis. Let me skip this because all of you should be aware of this. But in a nutshell, one possible interpretation is that China adopted a smart, modern version of mercantilism, massive hoarding of reserves. This is policy that included delaying the onset of real appreciation with massive sterilization of expanding trade surpluses and financial inflows. Of course, this was before the crisis. The situation now may differ. Now, the growth, especially after the accession to the WTO, was outstanding, but it comes with hidden and growing costs. One manifestation of this is, of course, the problematic balance sheet of China. But at the same time, another manifestation is that China became dependent on external sources of net demand. And of course, the growing financial crisis induced the massive deleveraging and the collapse of the demand coming from the US and from Europe. So this forced rebalancing, which is a work in progress. And after the crisis, Chinese authorities put the internalization of the Chinese yuan as part of the coming agenda. And also, they, around 2008-9, they engage with liberalization, allowing easier outward FDI from China to other countries. So what you can see here is a summary, let me focus on the right chart. At the bottom, you can see the association, the patterns of the current country GDP over time. This line is around the accession to the WTO. At the top, you can see the GDP growth. And notice that both the current account GDP surplus and the growth picked up around 2000-2001, and this was the time also that reserves picked up massively. Now, the big story is that this strategy was highly successful if you are defining the success as the ratio of US to Chinese GDP in current US dollar. The US was 8 times the size in this metric of China around 2001. Its relative size dropped to being twice the size of China in 2012. And if you believe the projections of the economists, around 2025, China will exceed the size of the US in current US dollars. Of course, if you're adjusting to purchasing power parity, China by now is larger than the US. Now, this matters a lot because once the China is reaching the size of the US and the EU bloc, China cannot bank anymore on export-led growth strategy because it will be very hard to find a counterparty that will be able to increase the demand in a way that is matching the desire of China to keep up its growth rate. So in this context, the strategy of pushing the internalization of the Chinese renminbi arrived at an interesting time. And to recall, part of this strategy became the provision of a lot of swap lines to a lot of countries. And in terms of the timing, I'm sorry you cannot see this, but here you can see a summary of the swap lines by 3 parties. The US Fed that extended massively the swap lines around the onset of the crisis from 2007, but most of the swap lines extended by the US Fed, with the exception of 4 emerging markets, most of these swap lines targeted the OECD countries. With the lag, the ECB followed the same, but all the swap lines, particularly of the ECB, targeted mostly the OECD. China is the exception. Most of the swap lines of China that also followed the dynamics of the crisis, most of them are targeting developing countries and emerging markets, including Argentina and a bunch of countries of similar characteristics. And by this I mean countries that in terms of sovereign risk are definitely not at the league of OECD countries. Now, in a paper with Gourdian in 2010, we pointed out that the swap lines that were extended by the US Fed to Brazil, Korea, Mexico, and Singapore are representing an interesting case study because one can ask what is the selection criteria that explains this. It turned out that, not surprisingly, it was really the self-interest of the US because these 4 countries were heavily exposed in the sense that sovereign default or other troubles in these countries will impose with lag significant cost on the financial system of the US, so it makes sense to extend them and not to go beyond this, partially because of some political economy challenges in the US. Let's skip this point. But to a degree, the data suggests, and I'm referring here to a study by Garcia, Herrera, and Xaya, they use our methodology with respect to China, and they came to the same correlated conditions that the swap lines of China are really part of a complex, if you wish, bundling strategy that is looking at the entire metric of the association of these countries with China. Now, if you look at the logic of bundling, let me mention two classical papers. One is Adams and Yelin. Bundling is a manifestation of market clout in which the bundling party leverages its market power, aiming at increasing the surplus. Potentially equally important bundling aspect is by Nelboff. Bundling is an effective entry deterrent strategy. And it's fair to say that both aspects may be playing a role in the bundling decision of China. And here, let me point out that in this paper we argue, maybe after the crisis, China is entertaining a new chapter in its outward orientation, a strategy that aims at securing a higher rate or higher rate of return on the net foreign asset position of China, leveraging the success of China in becoming the global manufacturing hub, and if you wish, the supply of swap lines, and also having the capacity to engage developing and emerging countries with a lot of infrastructure construction projects and the like. After the crisis, China bundled the outward FDI with its financial dealing, including lending, swap lines, trade credits, and the like, and also outward FDI, including export of capital goods produced or in the context of massive infrastructure, where Chinese labor services are playing a role. And this definitely is a smart strategy that may be down the road a win-win to both parties. Now, this bundling strategy has been mostly applied to developing and emerging markets economies and to commodity countries. And during the crisis and aftermath, China increased rapidly in tandem its outward FDI swap lines and imports and exports to the selected countries. Now, here you can see the map of the engagement of China, and I would like to focus on the sectoral. Here you can see the sectors. The largest part of this strategy is in the energy sector. The next is in metals, and the third is in transportation. So this is a part of the focus of China, mostly on developing and emerging countries in these important sectors. Here we have a heat map that at the top you can see the sample base of greenfield FDI as a ratio of the recipient countries, and the bottom, the bilateral trade as a ratio of the recipient country's GDP, and notice the tight correlation between the two. Now here you can see correlated information. Now this is a diamond chart. At the top, this is the greenfield FDI of China to the recipient countries. To the right, this is the export as a fraction of the GDP of the recipient countries. To the bottom, swap lines, and this is imports, all as a fraction of the GDP of the recipient countries, and this is the average for all the recipient countries. Notice that before the crisis, the presence of China was quite anemic, is summarized by this triangle. After the crisis, this emerged into a significant diamond, and this is really part of the story that we are trying to track. So turning to what we are doing in the paper, we evaluate the association of the various bundling dimensions in the regressions that are attempted to control for gravity and other factors in a two-stage regressions. We identify the positive association between Chinese outward FDI trade and finance. Commodities imports are positively correlated with FDI outflows. Now, exports of manufacturing are negatively associated with FDI outflows from China. And the positive association between Chinese outward FDI and commodities imports increases with the provision of the Rombini swap lines to Chinese trading partners, and this association became much stronger since the crisis. Now, the association of the Rombini swap lines with the Chinese outward FDI in the natural resources is especially large. Now, something that goes beyond the paper that you have, following some comments of a referee, we looked more carefully at the possibility that there is a differential patterns between the private and state-owned enterprises in the outward FDI. And we, in this regression, we have something like, if I recall, roughly 400 observations focusing on the largest. And the bottom line, trying to disaggregate between the private and non-private, the state-owned enterprise is not changing the big picture. The only point is that the commodity imports increase of the outward FDI by state-owned enterprises are higher than it does by the private ones. But otherwise, the main results are not sensitive to these patterns of disaggregation. So let me conclude. In the aftermath of the crisis, Chinese outward FDI is bundled with trade and finance linkages, thereby increasing the country's influence in the global arena, securing its long-run access to relatively stable supply of commodities. Now, of course, the shortness of the sample is not allowing us to make any assessment to what degree this was a smart strategy. But if you recall that the alternative to this strategy is being stacked with 4 trillion of low-yielding reserves, so relative to this benchmark, I expect that this strategy to deliver a sensible return, but of course time will tell. Now, the willingness of China to extend credit lines and invest in countries with history of default, including Argentina, Venezuela, Zimbabwe. Venezuela was served more by loans, less by swap lines, raises concerns about the growing exposure of China to sovereign default and the risk of partial nationalization down the road. And of course, what China is doing, everybody did the same in the previous century, everybody, including the US in Latin America and Europe in Africa and the like. But what China is doing is more interesting because China is willing to bring to the table massive construction services in these continents that have been massively underserved. Now, some of the Chinese lendings to commodity countries is secured in-kind long-term payments in the form of oil and commodities to China. And it's fair to say that there is an element of being partially hedged by the growing dependence of some of these countries on Chinese infrastructure services, especially in the context of the need to maintain them. So I doubt if Argentina will be eager to default on China down the road if China will deliver all the promised projects. The chances are that they will rely on China to maintain it. And of course, they are stuck with excess supply of commodities, including soybeans and the like. They are not going to eat the soybeans to default. So chances are, because of the huge market clout of China as the destination of soybeans from Argentina, I would say that despite the fact that all of us agree that Argentina has a problematic record, I think that a fair share of the exposure of China may be naturally hedged. Now, the proposed formation of the Asian Infrastructure Investment Bank, in which China would be the main shareholder, may be a natural progression in this, I would say, new chapter of outward orientation. Now, of course, I mentioned before that according to Nalbaf, this is entered a strategy that will make it harder to the EU and the US to compete with China. But it's fair to say that it's more of the fault of these parties that didn't bother really to engage too much in the infrastructure of Latin America and Africa. So at the end of the road, my interpretation of these results is not a criticism of China. Simply China is arbitraging a margin that was neglected, and considering the inability to maintain the rapid export-led growth because of the collapse of external demand, it makes perfect sense for China to push this envelope. Thank you.
This paper, I think the paper, so here's my summary of the paper. So first, the authors summarize their view of Chinese integration with the rest of the world before GVC by the label of mercantilism. So simultaneously, China runs a current account surplus and then invests the surplus in low return foreign assets, mostly U.S. Treasury bills. And since the crisis, there's a change in the national strategy, which has multiple components. One is to adjust the composition of foreign assets more towards foreign direct investment for the purpose of raising returns, and two, to complement that by bundling other aspects of international interactions, such as aids to make sure the investment goes strategically to countries that export a lot of commodities to China, or countries that import a lot of manufacturing goods from China. And the other thing is to bundle swap lines, something that the Central Bank of China can do due to its large foreign exchange reserve holding, with the FDI strategy and trade strategy, and the authors label the new regime as the new mercantilism. My broad comment is, I think the paper is very, very strong in documenting the empirical patterns, including, first of all, certainly the previous thing I think we know. I mean, I agree with the author's assessment that pre-GFC, given the composition of foreign liabilities and foreign assets, returns on foreign assets on average tend to be substantially lower than returns on U.S. Treasury bills, are lower than returns on foreign returns on FDI coming into China, and the net can be negative, so no problem with that pattern. Also, the paper does a very good job in documenting the bundling, the correlation in FDI pattern and trade pattern in terms of bilateral and sector features, and the correlation between swap lines and FDI. I think the paper is somewhat less strong, and therefore potential more work needed is to support the author's labeling. Of this is a national strategy. Both the feature we see before GFC and the features the author point out after GFC is the national strategy, and B, especially the labeling of mercantilism, either the old or the new one. So that's going to be my broad comments. I'm going to expand this by 2 or 3 smaller comments. So first, the paper reports evidence that FDI and trade are strongly associated. Bilateral sector patterns of trade and FDI are correlated. In particular, China's bilateral outbound FDI tend to be strongly correlated with China tends to have more FDI in countries that import a lot of Chinese manufacturing products. China tends to have more FDIs in countries which tend to produce and export commodity products to China, and their patterns confirmed by a 2-stage least square regression, and the effect seems to be stronger post 2008. And then author used this pattern to cite the pattern as support for the claim of a national strategy. I guess so. My main on this, my main question is, whether the national strategy part follows from the pattern or not. Perhaps requires more evidence. In particular, in principle, this correlation in patterns can come naturally from market forces. That it would only, if you think about your completely profit-driven private firms, where do you want to invest abroad if you do want to invest abroad? If your country has a lot of, if you are a mineral copper company, imports a lot of copper, so you have spare cash to invest, it would make sense to invest money where copper is produced. Therefore, in principle, the correlation can come entirely from market forces without the statecraft, without the national strategy. And one way to separate the two, I thought, based on the version that I have, is to actually to separate outbound FDI driven by state-owned firms, which one could perhaps make the argument that their action reflect at least in part of national strategies, versus that of private firms, which is essentially care about the profits, but not so much about what the party says. Now, under the hypothesis that the correlation reflects market forces, then you might see both state-owned firms FDI and private-owned firms FDI shows the same correlation. Under the alternative strategy that FDI, that there is actually a coherent national strategy, then you will see the pattern mostly applies to state-owned firms, but less to private sector-owned firms. The version I have actually does not do that distinction, but I was very pleased to see that in Joshua's slides, you should have a table on this. You said it's in response to the free comment. So it's a great thing to do. The slide didn't stay on the projected too long. My very quick reading seems to, I didn't see a big difference between the two types of investment. So when there's no big difference of the two, my interpretation would be perhaps it suggests that the pattern, correlation pattern, could reflect mostly of underlying fundamentals. Like if private sector firms do the same thing as state-owned firms when it comes to where to put their outbound FDI, it's less obvious. It's really an outcome of national strategy rather than just common fundamentals driving those patterns. That's comment number one. Comment number two. The authors look at shows that the combination of which country have a swap line from PBOC and whether the country exports commodities to China massively or not seems to be associated with an increase in outbound FDI in that country from China. Again, the authors interpret this pattern, bundling, as reflecting national strategy. That certainly is a possibility. On the other hand, precisely because outbound FDI can also result from private decisions, I thought that it would be nice to do the other, turn around the regression, since swap line, on the other hand, are decisions of the central bank, a agent of government. Perhaps one can do more by exploring where swap lines are signed, going beyond what Alicia and her co-author did. I guess the general idea is that if the authors wish to push the national strategy interpretation, it will be nice to look more at variables that are clearly decisions of the state, and B, to contrast that with decisions made by private sector as a way to separate the national strategy interpretation from the alternative, which is market fundamentals driving those things. A sense that I think the paper's evidence is suggestive, could be consistent with the national strategy interpretation, but perhaps more is needed to support this. I guess I find the labeling of mercantilism especially requires additional evidence. Nothing in the tables and graph, I think, clearly shows mercantilism in my mind. As an example, let me just use this as last slide. Even for the pre-global financial crisis period, when you see a country simultaneously run current account surplus and then simultaneously receive a lot of inbound FDI and therefore pay a lot to foreign investors in the form of high returns on FDI, and investing a chunk of its national savings in low-yielding foreign assets. We have papers that shows that you can this can come from market fundamentals. I only cited my own papers that shows that certainly conceptually and empirically, you can have other non-mercantilist explanation for those kind of patterns. In the two papers I cited was Jian Dongju. In particular, let me just describe verbally the paper in 2010 in AEJ, domestic institutions and bypass effect of financial globalization. What we do is to show, let me first conceptually then some data, the following very simple ideas. When you when countries have lousy financial institutions, in our case, we look at the 3 dimensions financial institutions, quality of financial institutions, relatively high expropriation risk, relatively low efficiency, or high cost of intermediating savings to investment, and the relatively poor quality of corporate governance. In our case, it's modeled as the relatively high size of private benefits. So our model is a marriage of international finance model and the corporate finance model. And one of the key results from this is in our story, there's a very natural distinction between interest rate a country's financial system pays on savings and return on physical investment. So the gap between the two reflects the efficiency of a financial system. Once you have that, it's actually not that difficult to generate the result that the country will simultaneously invest the savings abroad because domestic financial system is too lousy related to financial system abroad. Savers can get at the same time. You have a net inbound FDI, and that's because the return to domestic physical capital is really high. This is a low-income country that has a low capital stock per person. So it's not that, it's actually very natural for typical emerging market to simultaneously exhibit the pattern that return to physical capital is very high, justifying massive inward FDI, and return on financial savings is very low, reflecting terrible efficiency level of the financial system. And we, in that paper, documenting that around the world, a typical emerging market in fact exhibits those two-way capital flow patterns that you simultaneously do this. And China turns out to be not that unique in that pattern. In fact, you can exclude China from this to get the same pattern. So to summarize, I think some of the labelings perhaps either need not be there or will require more work to support. Thank you very much.